Americans For Fair Taxation presents the weekly Chairman's Report, written by Steve Hayes, president of Americans For Fair Taxation, and recorded by Bob Paxton, a volunteer with the Florida FAIRtax Educational Association. And now, this week's Chairman's Report.
Hello, I'm Bob Paxton with the AFFT Chairman's Report for Friday, June 21st, 2019. The Merriam-Webster Dictionary defines a tariff as 1. A schedule of duties imposed by a government on imported or, in some countries, exported goods, or 2. The duty or rate of duty imposed in such a schedule. Tariffs are used to raise money for governments, but often they are used to increase the prices of imported goods competing with domestic producers. Sometimes they're used for political purposes to ensure that foreign governments treat a country's imports fairly. For example, President Trump believes that China has serious restrictions in place limiting U.S. exports to China, while at the same time taking advantage of U.S. policies which place very few restrictions on China's exports to the United States. Many are concerned that these new tariffs on China and others will increase the prices that Americans pay for many of the goods they buy. In an article published on June 7, 2019 in Bloomberg News entitled "Trump's Tariffs Have Already Wiped Out the Tax Savings for Average Americans," Laura Davison makes a number of predictions on what will happen if the tariffs are continued. Among them, according to the Urban Brookings Tax Policy Center, middle-income earners saved an average of $930 in the 2017 tax reform bill. The tariffs already put in effect by the president will cost the average household about $831, according to the New York Federal Reserve, wiping out all but $100 of the tax savings. If Trump does impose another $300 billion in Chinese tariffs, this will cost an average family of four around $2,294 annually. Let's look at tariffs and the cost of goods. Sometimes opponents of tariffs, like Ms. Davison, argue that each 1% increase in tariffs will lead to a 1% increase in consumer prices. However, like most things in the real world, this is not the case at all. For example, a manufacturer in China sells a mobile phone to a U.S. mobile company for $300. The U.S. company will sell that phone to a U.S. consumer for $600. Now, if there's a 10% tariff imposed, the U.S. company will now have to pay $330 for the phone. Then, assuming competition allows it, the price to the U.S. consumer rises to $630. But in most cases, though, the competition will adjust the prices charged to the U.S. company and ultimately to the U.S. consumer. There's a growing manufacturing base in many other Asian countries who are competing to take business away from China. In fact, Foxconn, the company that assembles the iPhone, has assured Apple that it will move its assembly operations to another country if the tariffs on China become too costly. Now, the Chinese manufacturer is making a profit at that $300 selling price, so the question becomes, is that profit enough to allow the manufacturer to absorb the entire $30 tariff? Now, obviously, the manufacturer will not want to do that and will try to negotiate with the U.S. company for it to absorb some of the cost. If the U.S. company decides it cannot pass the full cost of the tariff on to the U.S. consumer, then the U.S. company will have to absorb some of the cost as well. In this case, the price to the consumer may increase some, but not by the whole $30, and there's a chance it might not increase at all. Let's look at the difference the fair tax would make. The main purpose of tariffs imposed by President Trump is to force other countries like China to stop limiting U.S. imports into their country and to stop stealing U.S. intellectual property. However, as Ms. Davison's article predicts, there may be price increases borne, at least in part, by U.S. consumers. Tariffs may still be needed after the fair tax is enacted to prevent bad acts by foreign governments, like stealing U.S. intellectual property. But remember that under the present income payroll tax system, U.S. exports are punished and imports are subsidized. Now, this is a simple calculation. All of our main trading partners have a value-added tax. As a product goes through the stages of production, the VAT is applied to the value added at each stage of production. For example, when trees are harvested and delivered to a sawmill, there is value added to the harvested trees. This increase in value of the delivered trees compared to the value of the uncut trees is taxed at, say, 20%. When the sawmill cuts the trees into planks and they're delivered to lumber yards for sale, there's value added again, and this additional value is taxed at 20%. Then when a furniture manufacturer purchases the planks and makes a table, this value added is again taxed at 20%. When the table is exported to the United States, the exporter is entitled to a refund of the total VAT paid, 20% of the final cost. Therefore, it comes into the United States at a price 20% less than what it would cost if it were purchased in the manufacturing country. When the table arrives in the U.S., in almost every case, there is no tax on the imported table. Now, the U.S. company pays taxes, but only on the net profits it obtains from its business operations, not on the value of the imported table. Now, this is in stark contrast with how we treat our exported goods. The U.S. exporter is not refunded the accumulated costs of the U.S. tax system, estimated to be 15 to 20% of the product's cost. This means the U.S. product goes to the other country at its full disadvantaged price. When it arrives at the other country, that country slaps on its VAT, and this increases the price even further, often to a level 20% higher than the competing foreign product. This 15 to 20% penalty on U.S. goods increases the likelihood that U.S. companies cannot produce products in the U.S. at a competitive price. This reduces U.S. employment and generally results in lower paying jobs for people who deal with the imported goods. The fair tax totally changes this dynamic. Since the fair tax is imposed only at the retail level, the wholesale prices of U.S. produced goods will not include the 15 to 20% cost of the current payroll income tax system. Imports will find, like in their own country, that they're also subject to the fair tax when sold in the U.S. at retail. This means the foreign goods no longer have the competitive advantage of selling in the U.S. at 80% of the price at which they would sell in their own country. Under the fair tax, U.S.-made products are more competitive with imports. This leads to an increase in U.S. production and creation of more high-paying jobs in the U.S., not in other countries. By equalizing the tax treatment of imports and exports, like all of our trading partners do now, we eliminate the need for most tariffs. In conclusion, President Trump is saying he's standing up for America. Now, it's more sensible not to cause other countries to impose retaliatory tariffs on U.S. imports when the real solution is so much simpler. Replace this nightmare called the income payroll tax system with the fair tax. Yes, there will be howls of protest from countries who have been taking advantage of our terrible and broken income payroll tax system for decades, but we say to these countries who suddenly have lost their competitive advantage that they enjoy under the income payroll tax system, sorry guys, we're just doing the same thing you do.
This has been the Weekly Chairman's Report, written by Steve Hayes, President of Americans for Fair Taxation. Check back every week for news and information about the fair tax, and learn why the fair tax should replace our antiquated federal income tax system. If you'd like to receive a copy of the Chairman's Report in your inbox every week, sign up at fairtax.org or bigsolution.org.